In 1987, the average cost of a four-year public university in the United States, tuition, fees, room, and board, was about $3,800 a year. Adjusted for normal inflation, that should be around $10,000 today. It is $28,000. Private universities that cost $9,000 a year in 1987 should cost roughly $24,000 today. The average is now $58,000. Something happened between then and now that had nothing to do with inflation and everything to do with a financial system that found a perfect, captive borrower. Someone too young to understand compound interest, too optimistic to model failure, and legally bound to a debt that, unlike every other debt in America, cannot be discharged in bankruptcy. You cannot walk away from a student loan the way a failed business owner walks away from a business debt. You cannot restructure it the way a corporation restructures in Chapter 11. It follows you. It compounds. And the system designed to help you repay, it was quietly redesigned over the last 20 years to make sure you never fully do. Another person graduated with $68,000 in federal loans at 22. Enrolled in an income-driven repayment plan because the standard payment was $700 a month and she was making $38,000 at her first job. Her monthly payment under IDR was $190. Felt manageable. What nobody told her was that $190 didn't cover the interest accumulating each month. Her balance was growing, not shrinking. At 31, 9 years into repayment, she owed $79,000. She had made 108 consecutive payments, and her debt was larger than the day she graduated. Third person, 29-year-old teacher in a public school. Enrolled in public service loan forgiveness, which promises to cancel your remaining federal loan balance after 10 years of payments in a qualifying job. He made every payment. He submitted every form. At the 10-year mark, he applied for forgiveness. The Department of Education rejected him because one of his loan types was technically ineligible under a rule that changed after he enrolled in the program. He owed $94,000. He had been told for a decade he was on track. He was not. Here's the pattern. These aren't edge cases. These are people who made reckless decisions or attended diploma mills. These are ordinary people who did exactly what the system told them to do: borrow what you need, go to school, get the degree, the income will justify the debt. And the system lied. Not through a single dramatic betrayal, but through a quiet, compounding architecture of deferred consequences and fine print that an 18-year-old cannot possibly navigate correctly. So here is what we are doing today. I am going to show you why the federal student loan system is structurally different from every other form of debt in America and why that difference is catastrophic for most borrowers. I will explain how income-driven repayment, the program sold as the safety net, often functions as a debt extension machine. I will break down the forgiveness programs, what they promise, what they deliver, and why the gap between those two things has destroyed the financial plans of millions of people who trusted the government's own numbers. And I will show you what the people who actually escaped this did differently, because some people do escape it, and the path is not what the financial advice industry tells you. Think of the student loan system as a hotel you checked into when you were 18. You signed the guest agreement without reading it because everyone told you this was the best hotel in town, and the price was worth it. What you didn't know was that the hotel charges interest on the interest. That the checkout process requires a specific set of forms filled out in a specific order over a period of 10 to 20 years. That the hotel can garnish your tax refund, your wages, and eventually your Social Security check if you don't pay. And that the one escape route, the side door marked bankruptcy, has been welded shut specifically for hotel guests. Every other guest in America, the failed entrepreneur, the over-leveraged homeowner, the person who ran up $80,000 in credit card debt, they all have a legal mechanism to reset. The student loan borrower does not. That was not an accident. That was a legislative choice made in 2005 when Congress effectively removed private student loans from standard bankruptcy protection, building on a 1976 law that had already done the same for federal loans. The stated reason was moral hazard. Lawmakers argued that if students could discharge loans in bankruptcy, they would take on debt irresponsibly. What actually happened is that without the threat of discharge, lenders had no natural market check on how much they were willing to lend or at what price. The risk was socialized. The profit was privatized. Tuition went vertical. Here is the math that most 18-year-olds are never shown. Let's say you borrow $45,000 at 6.5% interest, which is close to the current federal rate for undergraduates. Standard repayment is 10 years and your monthly payment is $511. Total amount repaid, $61,300. You pay $16,300 in interest on top of the $45,000 you borrowed. That is uncomfortable but survivable if your degree produces income growth. But here is what happens when the income doesn't materialize as expected, which is the reality for a significant number of graduates in fields like education, social work, the arts, or anyone who graduated into a recession. You cannot make $511 a month. So you switch to an income-driven repayment plan. The government caps your payment at 10% of your discretionary income. If you're making $38,000 a year, your payment might be $170 a month. You think you are managing the debt. You are not. At 6.5% interest on a $45,000 balance, your loan is accruing about $243 in interest every single month. You are paying $170. The other $73 gets added to your principal every month. This is called negative amortization, and it is the mechanism by which people who are faithfully making payments watch their balances grow year after year. The loan is a living thing now. It is feeding on itself. After 5 years of payments, you have paid the government $10,200 and you owe more than you originally borrowed. The system is not broken. This is the design. Now, let's talk about the forgiveness programs, because this is where the psychological damage is worst. Not because forgiveness doesn't exist, but because the gap between the promise and the delivery has been so large for so long that it constitutes something close to institutional fraud, even if no single person is legally culpable. Public service loan forgiveness was created in 2007. The promise was simple. Work for a qualifying government or nonprofit employer, make 120 monthly payments on an income-driven plan, and your remaining balance is forgiven, tax-free. 10 years. Sounds like a reasonable deal. In 2017, the first borrowers who had enrolled in 2007 became eligible to apply. The Department of Education approved 96 of the first 29,000 applications. Not 96%. 96 people. 1/3 of 1%. The rejection reasons included having the wrong loan type, the wrong repayment plan, missing a form, or one payment that didn't qualify for a reason the borrower was never informed of. These were not lazy people gaming the system. These were teachers, nurses, public defenders, social workers, people who had structured their entire financial life, their income choices, their housing choices, their family planning around a government promise. And the government couldn't keep a straight answer for 10 years about what qualified. By 2023, the approval rate had improved. It was still under 4%. If a private company sold a product with a 4% delivery rate, the FTC would shut them down. Here is a concrete scenario. Meet Jordan. Jordan is 24, just graduated with a degree in social work. $62,000 in federal loans. Starting salary at a nonprofit, $36,000. Jordan is smart. Jordan researches and discovers PSLF. Perfect, Jordan thinks. I'm already going to work for a nonprofit. This is exactly what the program is for. Jordan enrolls in an income-driven repayment plan. Monthly payment, $155. Jordan's interest accrual, $335 a month. Jordan dutifully submits the annual employment certification form every year. Fast forward 10 years. Jordan is 34. Has made 120 qualifying payments, applies for forgiveness on a balance that has grown from $62,000 to $71,000 despite a decade of payments. The application is denied because one of Jordan's loans from the first semester of junior year was a Perkins loan, which was technically ineligible under PSLF rules that Jordan was never clearly informed of at disbursement. That loan represents $4,200 of the $71,000 balance. The Department of Education offers no remedy. Jordan now either pays off the entire balance or re-enrolls in IDR for another 10 to 20 years to reach income-driven repayment forgiveness, which, unlike PSLF forgiveness, is taxable. Jordan will owe income tax on whatever is forgiven, potentially $15,000 to $20,000 in a single tax year. The bill arrives like an ambush from the future. Imagine a conversation between Jordan and a Department of Education representative. I've been making payments for 10 years, and you're telling me my loans don't qualify. That's correct. The Perkins loan was not eligible under PSLF. Why didn't anyone tell me that in 2014 when I enrolled? We provided information on our website. I was 24. I didn't know what a Perkins loan was. Is there any recourse? You can contact the ombudsman. What does the ombudsman do? They review your case. And then what? They provide a response. Silence. Because there is no good answer. The system was complex enough to be functionally deceptive without being technically illegal. Here is the mechanism nobody explains. The federal student loan system is one of the only consumer debt products in history that is simultaneously government-backed and profit-generating in ways that create no incentive for servicers to help borrowers pay down debt efficiently. Your loan servicer, the company that actually handles your account, is paid per account, not per dollar repaid, not per borrower who reaches forgiveness, per account under management. An account that is repaid quickly is an account that stops generating servicing fees. An account in a 25-year income-driven repayment plan is an account generating fees for 25 years. Now ask yourself, what does a rational servicer do when a confused borrower calls and asks about their options? Do they explain the aggressive repayment strategy that pays off the loan in 5 years and costs the servicer the account? Or do they default toward the income-driven plan that keeps the account alive for 2 decades? Multiple government audits and borrower advocacy lawsuits have found that servicers systematically steered borrowers into forbearance and income-driven plans rather than forgiveness-eligible pathways, even when forgiveness was the better option for the borrower. Navient, one of the largest servicers, settled with 38 state attorneys general in 2022 for exactly this kind of conduct. The settlement was $1.85 billion. The company had serviced over $300 billion in loans. The math on the settlement tells you everything about who the system was built for. So, what do the people who actually win this game do? Because some people do. Here is the protocol based on what actually works, not what the system advertises. First, understand your loan type before anything else. Federal loans are not all the same. Direct loans qualify for PSLF and most IDR plans. FFEL loans do not, unless consolidated, and consolidation resets your payment count. Perkins loans require specific handling. This is not complicated information, but servicers will not volunteer it. You have to ask the right questions before you enroll in anything. If you don't know what type of loans you have, go to studentaid.gov right now and look. Not tomorrow. Second, if you are in public service or a nonprofit and genuinely pursuing PSLF, submit the employment certification form every single year, not just at the end. This creates a paper trail that has repeatedly been the difference between approval and rejection. And if any payment ever shows as not qualifying, investigate it immediately rather than assuming it will work out. Third, if you are not in qualifying public service, income-driven repayment is often a trap dressed as a lifeline. The only way IDR makes mathematical sense is if your balance is so large relative to your income that it will never realistically be repaid, in which case you are intentionally running out the clock to forgiveness while accepting the tax bomb at the end. If your balance is manageable relative to your income, aggressive repayment beats IDR almost every time because negative amortization will cost you more in the long run than the short-term payment burden. Run the numbers on a loan amortization calculator with your actual interest rate. See what your balance is in 5 years under IDR. Then compare it to 5 years of aggressive repayment. The difference is often shocking. Fourth, refinancing federal loans into private loans is almost always a mistake despite what private lenders will tell you. You give up income-driven repayment, deferment options, and any remaining shot at forgiveness in exchange for a lower interest rate. If anything goes wrong, a job loss, a health crisis, a recession, you have no federal safety net. The lower rate is real. The risk you absorb to get it is also real, and most people don't price it correctly because the bad scenario feels abstract right up until it isn't. Fifth, and this is the one that cuts against everything the system tells you, the most powerful financial decision a 17-year-old can make is to treat the total cost of a degree as the negotiation it actually is. Community college for 2 years costs roughly $8,000 to $12,000 total. State university for 2 years after a community college transfer, maybe another $25,000. The same credential at a private university with a prestigious name, but no scholarship, $200,000. The labor market cares considerably less about where you got the credential than the admissions industry wants you to believe. The prestige premium is real in a narrow set of professions. It is largely mythological in the broader economy. A degree in nursing from a state school produces the same licensing outcome as a degree in nursing from a school that costs 3 times as much. The $120,000 difference in debt at graduation is not a minor footnote. It is the difference between financial stability at 35 and financial fragility at 45. Here is the identity shift that needs to happen at the cultural level, though I'm aware no single video produces cultural change. We have built a system where the financing decision is made at 17 or 18, the consequences arrive at 22, and the full weight lands somewhere between 30 and 50 when the borrower realizes the income trajectory they were promised did not materialize the way the college's own marketing suggested it would. The counselors who help students pick schools were not financial advisors. They were enrollment professionals. The financial aid office that presented a package was not neutral. It was working for the institution. The federal government that backed the loans had no stake in whether the degree produced value. It had every incentive to make borrowing easy because easy borrowing kept tuition growing and kept universities, large employers in key political districts, financially healthy. The 18-year-old signing the promissory note was the only party in the room without institutional representation. Here are your 3 takeaways. 1. Income-driven repayment is not a repayment plan. It is a debt management plan that can extend your obligation by decades and end in a taxable forgiveness event that arrives like a financial ambush. Understand the mechanics before you enroll. 2. Loan forgiveness programs have fine print that has cost millions of borrowers a decade of planning. If you are counting on PSLF or any forgiveness pathway, verify your eligibility in writing every year with documentation, and do not assume that making payments means you are on track. 3. The best time to fight the system is before you borrow, not after. Every dollar not borrowed at 18 is worth considerably more than a dollar repaid at 38 with interest. The conversation about total cost, not just monthly payment, not just aid packages, but total cost over a realistic repayment timeline, is the conversation most families never have. Have it. The hotel is not worth the rate they're charging. And unlike most hotels, you cannot check out early just because you want to.